people save their money or take out loans from banks. In return, banks pay us interest on our money saved in their banks and charge interest on the loans they give to other people with their money. The question is, what do the banks do with your money? Your money does not stay in the bank. What do the banks do? They pay you a percentage of interest per year for depositing your money in the bank, and at the same time they lend your money to other people, so your money is not in the bank but in the hands of the person who borrowed it. You can say, but in my account balance is the money I deposited in the bank. But it is not true. What you see in your balance is a number, because your physical money was lent to another person, to earn more interest by lending your money to the other person. For example, you deposit your money in a savings account, which gives you 4% interest per year, on your money deposited 1 year in the bank. The bank takes that money and lends it to another person, who has to pay 8% interest to get the loan. That is, the bank is earning 4% annual profit with this banking operation. It gives you 4% interest for your money and charges another person 8%, which means this simple mathematical account is 8% charged to the person who asks for the loan minus 4% given to you for having the money saved in the bank. What the bank earns with this operation is equals 4% profit for the bank. It is the main business of banks, lending money with very high interest rates and giving a low interest to people who deposit their money in banks, for example in a savings account. Banks offer other types of services, but none of them are as lucrative as the one explained above. Let's imagine that most people don't pay their loan for some reason, such as a big financial crisis. Then in this case, the bank would not have the money to pay your interest and could not be able to pay you back the money in your savings account, since your money was never physically stored in the bank, as the bank would never have the money to pay you back. In this type of situation, what would the bank do in a catastrophic situation of this type? Declare bankruptcy and possibly lose all your money. As the banks have thousands of clients, if one client does not pay his loan, surely there will be another one who will pay his loan. With the money of those who pay, your annual interest will be paid and your pension fund will be insured. But since the bank lends out all the money that falls into its hands, if there is a big recession for example and all the people run to the bank to withdraw their money so as not to lose it, then the bank would run out of money very quickly and many people would simply lose all their money. But fortunately, we have central banks in different countries, which are usually owned by the government and impose certain rules on the banks. For example, the so-called encaje bancario, that is, you cannot give credits with all the money that the bank has from your deposits. A percentage of the deposits that people make has to stay in the bank as a guarantee. Being this way, they keep a reserve of physical money in case of a financial crisis. For example, in the United States, the Federal Reserve, or American Central Bank, requires banks to have a reserve in cash or Federal Reserve accounts of between 3% of your deposits and for larger banks 5%. Because if a small bank goes bankrupt it will affect fewer people, and if a large bank goes bankrupt it will affect many more people. For example, if a bank in a small town runs out of money, it would only affect the people in that small town, but if a large bank that lends money to a whole country runs out of money, it would affect millions of people. But the percentage that banks have to keep off the loans they make is very small, so it does not solve almost anything. Because if they keep, for example, 5% of the deposits, they can lend 95% to people who ask for a loan, besides lending the vast majority of the money they receive from people in keeping, for example, 5% in physical money. If most people decide to withdraw their money at the same time, the bank has a high chance of going bankrupt. For example, if there is a big financial crisis, people panic, everyone withdraws their money at the same time and the bank runs out of money to pay all these people. Usually, when something like this happens, governments intervene by lending money to the banks so that they don't go bankrupt and people don't run out of money. Another problem that happened, for example, a few years ago in Argentina, when people tried to withdraw their money from the banks at the same time, the banks froze people's accounts. In this case, with the account frozen by the bank, it is impossible to withdraw your money. Normally, this kind of catastrophic scenario does not happen. Because there has to be, for example, a big financial crisis, and normally when a big financial crisis happens, the governments intervene by lending money to the banks, so that they pay the people who want to raise their money. But it can also happen the other way around, if because of some important economic crisis the people who have loans, the great majority of them, could not pay their loans. Then the bank will run out of money again, since most people in a major financial crisis could not pay their loans, especially the big loans like those to buy houses, which are the most in need of money, have to lend by the bank. What options do people have with their money? It is not advisable to keep it at home, as it can be stolen or spoiled over time. The most reliable solutions are still to keep it in banks or to invest it, but every investment is always a risk. The truth is that we do not have any safe options, so that one day a financial misfortune can happen and people are left without their money.